Look, I think those rate cuts come from a reason, and the reason is that inflation is coming down. Now, when I look at the global inflation picture, it is one where inflation has been coming down already. We continue to do so in two stages. Just first stage, which has happened already, has to do with headline inflation coming down because of welcome supply side factors. Global supply chains are improving, energy prices are moderating, food prices likewise. So headline inflation has come down and quite fast. Now going forward, we see a second stage of declining inflation. That's going to be a bit trickier and more sluggish. Has to do with declining core inflation, services prices in particular, that will require cooler demand side conditions. So inflation comes down enough, we think, for central banks to cut, and they're going to cut quite soon.
I think it's worth saying to our audience as well that rates are never going to be where they were during the height of the crisis, though, because I don't think in our lifetime as well, unless there's another mega crisis of enormous proportions. So yes, rates will come down, but we're not talking about getting to anywhere near the levels of the lows of the last couple of years, are we? So
listen, when we talk about interest rates next year, people ask two main questions. When do they start cutting? And then how far they go. Yes. What's the extent of the cycle? So in terms of the second question, the extent of the cycle, we do think that by 2025, we're probably talking about rates closer to something around neutral. So right. What's neutral? Something in the range of 2.5 to 3% for the Fed, for the Bank of England, and for the ECB. With the caveat, though, that what the economists call R-star, or the neutral interest rate equilibrium, might be higher than otherwise for several reasons. One of them is fiscal policy, which is more expansionary now than it used to be. So to answer your question, yes, those times of great moderation, so to speak, with very low inflation and interest rates close to zero, we saw over a decade or so, those days are probably over.
Will the declines in rates, which start, again, you said Bank of England in June, Fed in May and ECB in April. Will those declines be enough to help out the vast numbers of companies, governments who have to issue vast amount of debt over the next 2 years?
It should, however, but with two caveats. First is that it takes a while for these rate cuts to filter through the economy and therefore help the recovery later on. And therefore, in the meantime, we have to say that the next few months are going to be showing weak numbers on the growth side. In the US, for instance, we had very strong growth in the third quarter. We already see clear signs of moderation now in the fourth quarter, and we do look for further weakening in the first half of next year before we see some recovery later on. Likewise, in the Eurozone, the third quarter was negative already. Fourth quarter is probably slightly negative. First quarter, maybe some signs of recovery. Green shoots will look forward. However, it's a sense of stagnation for a while. So before we have recovery, we have weakish numbers. And also for corporates that have to issue, they care not just about the short term of the curve, but also about the long term of the curve. So the short term of the curve is anchored on policy rate cuts. However, in the long end, there are a lot of supply and demand issues that are probably going to keep rates high for a bit longer.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.